So as we go into the second half of 2018 and beyond, we are now entering into the 10th year of a bull market. We've talked about the narrow market and the expansion of these growth stocks and the narrowness of that advance. We've talked about that usually ends with a pocket of volatility. Now, we're not calling for a bear market because the economy is doing well, but we are calling for continued volatility. And so when you're late in a bull market, when you have higher valuations, when you expect volatility, what does a portfolio do? What does an investor do? Well, traditionally you can go to bonds, but as we've discussed, the bond market is actually equally volatile and in fact not a reliable place to hedge at this time. So we have to go to non-traditional hedging strategies. That's hedge funds, that's private equity. Now, these assets, sometimes people get nervous because they're different, they're unique, they're alternative investments. But we wanted to take a minute and take a look at the reality, the fundamentals of these investments and why they work in diversifying a portfolio. This first chart shows to hedge or not to hedge. It shows a portfolio of 60-40, the traditional stocks and bonds portfolio to hedge portfolios. It shows just buying stocks alone, the orange line. And then it shows a portfolio of 60% stocks, 15% fixed income, and 25% hedge funds. That's more closely aligned with the way we would look at the world today. We don't love fixed income, and hedging strategies are usually at their best at the tops of markets. Hedge when things are high, not when things have already come down. What the chart shows us is that the 60-40 portfolio, while it hedges risk, it doesn't have the big swings that the other portfolio does. It also doesn't have the same return. The all-equity portfolio has the most volatility. It goes up quicker in hot markets. Just take a look at that June of 2000. Also take a look at this year. These are the couple points in time when markets are extremely hot that equity gets above the hedge portfolios. But when the market turns over, you'll see that orange line dip below the others. So a lot more volatility. Now, interestingly, the hedge fund portfolio mixed with fixed income and equity basically gives us almost the same return as the all equity portfolio, but it does it with less volatility. And there's actually only 2 points in time where it doesn't actually outperform, and that was at the top of the market at 2000 and today, where we're in a 10-year bull market. So the answer is, when would you have wanted to own these hedges? Well, you certainly would want them in 2000. You certainly would want them in 2008, 2009. And yes, while we're not calling for a bear market immediately, now is the time to start hedging the portfolio. We believe they work here. In fact, this next chart shows during negative equity markets, hedge funds actually perform exceptionally well. So this is since 2009. This is every month where we had a negative equity portfolio. And what we can see is this is the percentage of outperformance hedge funds had during down months. So this is very interesting. This says that hedging works when equities are down. They help the portfolio. The next chart shows when bonds are actually negative. When we're seeing negative performance in a bond portfolio, how do these hedge portfolios work? And the answer is, again, they outperform during rising interest rate periods in the market. So hedge funds right now to hedge against a problematic bond and potentially an equity market volatility. Private equity is also another way to take volatility out of the portfolio. Private equity is obviously, it's not marked to the market every second of every day as every trade comes through. These are funds that go out and buy private businesses. They only mark their portfolio when there's a need to change valuation. And so with the private equity portfolio, we can still get outsized returns. It's called the illiquidity premium. When we buy private equity, because we're tying our money up for a long period of time, so this is not for everyone, it's for the investors that can put some money aside for 5, 6, 7 years, we demand a higher rate of return, higher than the equity markets, and yet we get less volatility. Now, it's important to note, not less risk. Risk is the losing of your money. Volatility is the movement of your money, two very different things. But let's take a look at private equity valuations and compare them to public markets. Back in 2011, the U.S. private equity market was a slightly lower valuation than the public market. And as we can see, European private equity actually had a higher valuation than the European public markets. That's back in 2011. By the way, that makes sense because this is during the European financial crisis. Fast forward to today, and U.S. private equity has a very similar valuation that it did back in 2011, despite this robust economy. And yet the U.S. public equity market valuations have exploded to the upside. So once again, that tells us there's value in the private equity world. And again, in Europe private equity is slightly lower valuation than European public equity. So from a valuation perspective, it checks the box. From a diversification perspective and from a hedging perspective, this next chart shows that if we look at private equity annual return minus the stock market, those are the blue bars. So obviously, whenever the bars are above the line, that means the private equity return is higher than the U.S. When it's below the line, it's earned less than the U.S. markets. The orange dots are the actual returns of private equity each year going back to 1987. So here's what the chart tells us. The chart tells us that private equity outperforms the equity markets, the public equity markets, most of the time. Additionally, private equity's only had 3 down years since 1987. Obviously much better than the public markets. So less volatility, less down years, outperformance most of the time, and the overall rate of return of private equity has been higher than U.S. equity over long stretches.